Imagine two traders looking at the exact same currency chart. The price drops by a tiny fraction of a cent. One trader loses $3,000, while the other loses roughly 30 cents. How is that mathematically possible? The difference between them has nothing to do with which specific currency they chose to trade. The difference is the actual volume of money they bought. In the foreign exchange market, you cannot log in and buy a single dollar or a single euro. Instead, retail traders buy and sell currencies in pre-packaged, standardized bundles. These bundles are called lots. Think of a lot size as a volume dial for your risk. It acts as a direct multiplier, dictating exactly how much financial exposure you carry for every microscopic movement on the price chart. To understand how these bundles work, picture a wholesale warehouse store. You don't buy paper towels one roll at a time. You buy them by the pallet or the massive box. Currency trading works the exact same way. This graphic shows the different tiers of currency bundles. At the very top is the standard lot. This is the massive cargo shipping container of the market, holding exactly 100,000 units of a specific currency. Stepping down from that, we have the mini lot. If the standard is a shipping container, the mini is a single wooden pallet, holding 10,000 units. Below that is the micro lot, which is comparable to a standard cardboard box of 1,000 units. Finally, at the very bottom is the nano lot, effectively a small handful of just 100 units. Because these volumes are so different, a single step down on a pricing chart impacts them uniquely. For the trader holding the shipping container, that tiny tick might equal a $100 loss. For the trader holding the nano handful, that identical tick cost them 10 cents. Choosing a lot size is the specific decision that turns an abstract squiggly line on a screen into very real financial stakes. If you look at any standard trading dashboard, the option to select your lot size is usually front and center. Selecting the wrong bundle size is the primary reason new participants drain their entire account balance on their very first day. The most common error is sizing a trade based on a gut feeling. A trader feels highly confident about a market direction, so they manually select a massive volume to maximize their return, ignoring the underlying mathematics. This visual represents over-leveraging. If you place a heavy 100,000 unit standard lot onto a tiny $500 account balance, the structure cannot support the weight. The slightest downward breeze in the market will snap the fulcrum and wipe out your entire account. Entering the market without a strict mathematical system for determining your volume means you are guessing. It shifts your activity away from tactical market strategy and directly into blind gambling. To avoid that trap, professionals use a concrete 3-step method to calculate their volume before every single trade. And fortunately, it requires zero manual math. This diagram illustrates step 1. You look at the chart and identify the exact price level where your trade idea is proven wrong. You place a red exit line, known as a stop loss, at that level. The physical space between where you enter and where you exit is your safety net. Step 2 assigns a strict cash value to that physical space. You decide the absolute maximum dollar amount you are willing to lose if the market hits that red line. For this example, let's say you are willing to risk exactly $10. Step 3 is where you size the box. You take that $10 risk and the distance to your safety net, and you type them into a standard automated lot size calculator. The software processes those inputs and outputs the precise lot size you need. It calculates the exact fraction of a bundle required, so that if the market hits your safety net, your account loses that precise $10 and not a penny more. Professional traders do not use lot sizes to chase profits. They use them to strictly cap their losses. Capping those losses consistently requires discipline. There are 3 industry-standard methods you can adopt right now to ensure your account balance survives volatile market swings. The first is the 1% rule. When you are deciding on that maximum cash risk in step 2 of our calculator, never let that number exceed 1% of your total account balance on any single trade. The second is the hard stop. That red exit line on your chart cannot be a mental note. It must be an automated order entered into your trading platform, so the system pulls you out automatically, completely removing emotional panic from the equation. The third is sizing down in chaos. When global news hits and market charts start moving erratically with massive price swings, you step down your volume. You drop from a mini lot to a micro lot, or a micro down to a nano. By combining these defensive sizing rules, A loss on the chart is no longer a major threat to your capital. It simply becomes a calculated, highly controlled business expense. Your immediate next step is to open a simulated demo account. Stick entirely to nano or microlots. Focus your energy purely on understanding market direction and flow, long before you ever consider scaling up your trade volume. Remember these 3 core concepts. 1. Lots represent physical trade volume. 2. Larger bundle sizes equal higher financial exposure. And 3. Strict mathematical risk limits must dictate your final lot size every single time. Mastering these calculations separates stressful, erratic guessing from the calm, intentional strategy used by professionals. To continue building that professional, step-by-step foundation for your trading journey, click subscribe to the Forex Alert. We'll see you in the next video.